Hello, welcome everyone. I'm going to give a few moments for people to join and then we'll get started.
This is the most dramatic opening to a webinar with your grandfather clock chiming in the background there, Michael.
Well, I share my home office with 3 parakeets. Wait till I start talking, and they like to talk when I talk.
Love it.
Eli wanted me to remind you all to try to mute yourselves when you're not speaking because it will help with the microphone feedback, just so you know. The mute button is on the right side of the control panel, or the left side of the control panel, but the control panel is on your right.
Just the little thing up there with the green microphone, yeah?
Yeah,
and just click it and it'll go dark, and then click it back when you need it, huh?
Yes.
Okay, I got it, I think.
Perfect. Well, I will go ahead and start with introductions. So good afternoon, everyone, and welcome to the Environmental Law Institute's webinar, Greenflation, Are Commodity Prices Actually Rising, and Will We See Long-Term Impacts? My name is Madison Calhoun. I'm the Senior Manager of Educational Programs here at ELI. I want to thank you all for attending today. We appreciate your time and your engagement. Additionally, I want to thank our fantastic panelists who are here today and who have prepared some great content for all of you. Today's webinar will include presentations from the panelists, followed by a roundtable discussion with time at the end for an audience Q&A. Please don't wait to submit your questions, though. You can submit them as soon as you think of them by using GoTo's question box. Additionally, today's slides are available on ELI's website, along with links to the panelists' full biographies. I will now turn things over to our wonderful moderator, Michael Curley. Michael joined ELI as a visiting scholar in 2013. He is currently teaching a graduate course in environmental finance at Wake Forest University. He is a lawyer who has spent the majority of his career in project finance and the last 25 years in environmental project finance. He has published over 40 articles, has contributed to the Huffington Post, and is a member of the American Society of Journalists and Authors and the National Press Club, where he sits on the book and author committee. You can find his full biography on ELI's website. Michael, take it away, and thank you, everyone.
Thank you very much, Madison, and welcome everyone to this webinar on an increasingly important topic nowadays, which is how is money going to affect people's efforts on climate change and other elements of the environment, sustainability, and so on and so forth. And so that, without further ado, let me introduce to you that we have 3 fabulous panelists today. Let me introduce them to you and turn you over to them. The first is Urvashi Kaul, who works in non-credit risk advisory at Capital One. Prior to this, Urvashi was an assistant director for economic research and analysis at the New York City Economic Development Corporation. Urvashi and I share economic development as our backgrounds before we got into the environment stuff. Urvashi also served as the standing advisor to the New York City Labor Market Information Service at the Center for Urban Research at the City University of New York. Since 2001, she's taught graduate level courses in economics, finance, and sustainable development planning at Columbia University, Pace University, and the Pratt Institute. A native of Kashmir, India, her education includes a master's in public administration from Columbia and a master's degree in economics from the Delhi School of Economics in Delhi, India, University of Delhi, India. And that's Urvashi, and she will be our first speaker. The second speaker will be Doug Vine, who is the Director of Energy Analysis at the Center for Climate and Energy Solutions. Doug leads the center's work on energy decarbonization policies and technology analysis. He is currently researching pathways toward decarbonizing power and industrial sector emissions, including widespread electrification and the use of low carbon fuels like hydrogen. Doug holds an MBA from the Victoria University of Wellington. He also holds a master's in science and systems engineering from Virginia Tech and a Bachelor of Science in Aerospace Engineering from the University of Maryland. Doug will be our second speaker. And last but not least is Sarah Orr, who is a partner in the Chicago law office of Kirkland and Ellis. Sarah advises clients around the world on environment, social, and governance issues. She has almost 2 decades of experience working with private equity, corporate, and financial institutional clients on thousands of transactions. Her practice specifically focuses on corporate sustainability programs, public company environmental and social governance reporting, environmental and social governance litigation risk analysis, and shareholder activism, corporate governance, ESG due diligence, and supply chain and human rights issues. A lot of stuff that Sarah is involved in. Sarah got her undergraduate degree from the University of Illinois, and she got her law degree from the University of Michigan. So we're delighted that Sarah will be our third and final speaker. And so without delaying anything any further, let me turn you over to our first speaker, Urvashi Kaul. Urvashi, take it away.
Thank you, Michael. Thank you for the generous introduction. Madison, if you could go to the first slide. If you had told me that I am going to talk about prices and inflation and commodities prices and logistics on a Thursday afternoon, I might not have been that excited. But when you throw ESG into the mix, that increases the interest level for me tremendously. And without even realizing, I've started throwing out acronyms, and I should explain what I mean by ESG. For example, the acronym I just used. So if you could go to the next slide, Madison, please. ESG has evolved and also means different things to different people. Sometimes it's been used as an acronym for socially responsible investing and corporate social responsibility, impact investing, triple bottom line, etc. And I also have like a couple of graphics here that I pulled from Google. Simply put, I would say, if I had to define it in the simplest terms, I would say that ESG, or environmental, social, and governance criteria, the E, the S, and the G, they're a set of standards for assessing the impact of sustainability and business practices of a company, the impact on its financial performance, as well as its operations. To dig a little bit further, next slide, Madison, please. The E, the S, and the G, like I said before, the environmental, social, and governance criteria. In each of these, I'm attempt to give a little bit more color into each of these. When I say environmental, I mean the company's impact because of the use of its natural resources. It has an impact on the environment, and that's kind of what the environmental criteria try to measure, whether it's pollution or waste, how you use natural resources, energy efficiency, etc. When I say social, I am referring to the company's interaction with communities, whether it's human rights issues and its logistics and supply chain, whether there's a positive or a negative community impact, whether the impact is because of the inherent nature of what the company produces or its policies and practices. Impact could be negative, positive. Workforce and product safety, privacy, and such issues are kind of within the realm of social criteria. Lastly, the G, the governance criteria, it really refers to the internal decision-making and legal compliance of a company. It deals with like board quality, independence, and diversity, deals with shareholders' rights. How much does the highest paid employee or the executive make in compensation relative to the lowest paid employee, etc. What sets ESG apart, or the environmental social governance criteria, using ESG criteria, this methodology, what sets this apart is really the data-driven aspect of this. Increasingly, there are standards, ever evolving, but there are standards and metrics that help you measure risk. on the downside. And they also help identify opportunities and generate returns. So there's both like measuring and mitigation of risk, and also there's a creation of value. It has garnered interest, especially because ESG integration really has led to has resulted in mitigating risk and optimizing returns. It's a strategy to do so if you include ESG factors into your business analysis or investment decisions, etc. Next slide, please. And so, like I said, these the developments, how ESG has evolved, has kind of come to a point now where almost everyone is talking about it. When I started in this industry maybe in I started talking about ESG formally in 2012, 2013. I was at the Robert F. Kennedy Center before Capital One, where I started an investment and a program working with investment managers and asset owners to implement ESG criteria into their decision-making process. And at that time, people would actually tell me, what is ESG? And we are about returns. So, I would spend the first meeting explaining why ESG is relevant, but I don't seem to have to make that argument anymore. So things have evolved. ESG market is growing. Bloomberg estimates that ESG assets under management are expected to account for over a third of all global assets under management in 2025, at about $53 trillion. And this is really a midline estimate. They have a low, a high, and a medium. And the rate of growth in ESG assets that they extrapolate to get to this number is actually is more conservative than the rate of growth we've seen in the past few years. Without going into detail about like macro trends that might be impacting the interest in ESG, and I'm happy to go back to them if time permits, I want to concentrate now on, or focus now on the manifestation of some of the macro trends that humanity as a whole is experiencing. So there is an increasing shareholder acceptance of the importance and relevance of ESG. By stakeholders, I mean investors, business leaders, consumers, employees. Everybody acknowledge, all of these sets of people acknowledge, or these stakeholders acknowledge the importance and relevance of ESG. That's not to say that every business leader and every investor recognizes this, but enough to build a momentum. There is the EY report on the proxy season for 2021, ESG generated the biggest headlines, and there was a PwC survey end of last year. It says vast majority, 83% of consumers think companies should be actively shaping ESG practices, and they're willing to pay the premium for it. A vast majority of business leaders think via their company they have a responsibility, and employees think the same. So additionally, in addition to this corporate stakeholder trend, governments and international and multilateral organizations also are driving some of the focus as well. At an international level, there is the Paris Agreement, for example. It obliges its 195 signatories to reduce the risks and impacts of climate change. There's an objective to get to net zero by 2050. Or declining towards a net zero through mitigation and carbon removal efforts by 2050. The PRI, or Principles of Responsible Investment, which was again has about 2,500 signatories that are asset owners and investment managers. They have ESG objectives and policy commitments. They have like not investing in fossil fuel, increased reporting, disclosures. Then there are UN Sustainable Development Goals, or SDGs. There are 17 of them, and they also have about 169 associated targets. They're aspirational, and they impact commodities sector as well in their aspirational targets. They have targets such as sustainable management and efficient use of natural resources. They have a target on reduction on the amount of fossil fuel subsidies, for example. So all this is to say that many ESG actions historically would have been considered voluntary, niche, or sector specific, but all of these trends, whether it's business, consumer interest, government, multilateral organization interest, that has kind of resulted in ESG criteria finding a way into some regulations and laws in certain cases, in a few cases at least now, as becoming making ESG reporting mandatory for some in certain cases. And even if you're not listed, publicly listed company, you have more and more financial institutions, for example, have also started incorporating or having an ESG policy that restricts lending or investment in certain industries, like whether it be coal mining or fossil fuel extraction or private prisons or what have you. So all of this actually has been kind of exacerbated, if you will, in the last 2 years because of the COVID-19 pandemic. We can't really ignore it. It's the big elephant in the room. And that has highlighted the socioeconomic issues. And I think the focus of having that there's being an opportunity to build a more sustainable future has also kind of, if not reinforcing, but if not only reinforcing, but also accelerating these targets and objectives. So, why now? Because there's this confluence of all these trends coming together. Next slide, please. And ESG has, or environmental social governance criteria, incorporation of those and recognition of those as important has, of course, widespread implications. It affects all industries, and commodities are no exception. It's one of the biggest opportunities and challenges that commodities pricing or commodity demand supply might face. And there's no denying that commodities are here to stay. We need commodities, especially now. There's expected increase in demand because of large initiatives like we have to maintain and replace our aging infrastructure. We have to combat climate change. We have to have a carbon neutral transition to carbon neutral technologies. So all of these events, all of these trends are occurring simultaneously as there's an increasing concern about environmental and social impact of our actions collectively, our actions, which I include like corporate actions, government actions collectively. And depending on how it's done, the process, the life cycle of a commodity, like the process of acquiring commodities, whether it's via extraction or sourcing them from regions, say, where there might be a conflict, supplying them, transporting them halfway around the world, or even using them, like, we use coal and gas as fuel. Each of these separate actions can have an adverse consequence for the environment. It could raise governance issues. There could be like some employee discrimination issues, for example. There could be social issues, exploiting, having exploitative labor conditions, for example, which has been in the news. So all this is, to my mind, going to point towards the fact that there'll be an increased scrutiny of ESG policies and performance. Supply chain transparency will become more and more important to all stakeholders. The farm to fork framework is kind of widely talked about now, where you want to know where what you're using has come, where it started off and where it ends up. And all in all, while the demand is increasing, supply is constrained because of investment is curtailed in certain types of activities, like I said before, like mining or extraction. And then there are all these supply chain limitations, among other reasons, but these most relevant for the conversation today. And bottom line, there's a higher demand, there's a reduced or constrained supply, and so you would expect some pressure on prices and inflationary pressure. Next slide, please, Madison. There's a spectrum of opinions here. Madison, if you go to the next, thank you. Like I said, there's a spectrum of opinions here, and I would like to leave you with some sampling of each of the some of these opinions. I read in an article that going green could save the world, but we're all going to have to pay for it. At least some have that view, and there are worries that government policies and focus on ESG translate into higher costs for consumers. And we have a term for it, Greenflation. Whether accepted by all or not, but increasingly being used and the topic of conversation today, obviously. People like Richard Sharma, who's a chief global strategist at Morgan Stanley, he wrote in Forbes that this new government direct spending is driving up demand for materials to build a cleaner economy. And at the same time, there's tightening regulation, which means there's limits on investment in mines, et cetera. And so the unintended consequence here is an greenflation, or rising prices for metals and minerals that we need to build our green infrastructure. Jack Manley at JP Morgan Asset Management said in an article that it's an upward cost, the upward pressure for cost for going green or as a result of being green. So this is like one side of the spectrum. Next slide, please, Madison. Thank you. There's no denying that all eyes are on inflation, from like cars to electricity, housing, phones, food. We are paying more. Americans are paying more than they've had to pay in a long time. And in fact, so much so that worries about greenflation might even have impacted, Joe Manchin's willingness, or could be willingness to stall climate and social spending bill because of fears of accelerated inflation. So it has like real life impacts, obviously. And one of the views is that there is evidence of some of these prices increases are due to climate action. Like, I'm sure, Doug may go into this in more detail, but as an example, like coal is more expensive because of fewer US miners are producing coal and not enough to meet demand. Steel makers are cautious because of their carbon footprint, et cetera. But I don't think all of inflationary pressures could be attributable to greenflation. Greenflation is not everywhere. I read in an article, and I've kind of listed my sources where I'm quoting from the articles below in the slides as well. For example, increasing oil prices, I don't think we could 100% attribute to greenflation. There are other interests at play here in an effort to keep the prices high by OPEC, for example, or even the supply chain issues, like there are shipping bottlenecks. They continue to impact global trade and go beyond the energy transformation or greening of the space, if you will. Some people think that these pressures may be short term. For example, greenflation may be a concern in the short run, and because of decreasing cost of financing green projects, economies of scale, in the long term they will balance out the increasing costs. There are others like Bill Gates, who talked about green premium in his book. I think it's called How to Avoid Climate Disaster. And this green premium, or greenium, greenium just reminds me of the Green Lantern, the movie. I don't know why, but it does. But this green premium, Bill Gates defines as a difference in cost between a product that involves emitting carbon as an alternative that doesn't. And so, according to him, phasing out coal, having rolling out electric vehicles, it will be expensive, and in the short run, especially, some greenium or some of this green premium is inherently inflationary, and we must accept that in the short run. To take this to the other extreme of the argument, I read an analyst talking about this build back better. We're borrowing for building back better, and that's okay, because even though green fiscal stimulus will end up in an uptick in prices, it is worth it because the alternative is more dismal, is more bleak. There's a different kind of inflation if we don't do this. Potential for volatile, uncontrolled food prices, driven by extreme weather events, or a spike in the cost of everything from housing, insurance, etc. So, this is my attempt to give you quickly, at least, a spectrum of all the views on greenflation and what it means. And hopefully I've left you with enough food for thought. And I don't know if I'm on time or over. I'm sorry if I was over, but over to you, Doug.
Thanks, Urvashi. And thanks, Michael, and thanks to ELI for inviting me to speak here today. And thanks to everyone who's on the line and is listening in and for your interest in this topic. So I have a little short outline here on my opening remarks for today. I'd like to briefly reintroduce myself and my organization, and then I'll talk about the challenge of climate change, the basic plan for decarbonization, the opportunities and challenges that we face in decarbonizing the economy, including the challenge of greenflation. Again, my name is Doug Vine. I'm the Director of Energy Analysis at the Center for Climate and Energy Solutions, or C2ES. I've been with the center for 10 years now, and my work largely focuses on energy decarbonization policies and technical analysis, with a particular focus on reducing emissions in the power and industrial sector. So I knew I was going to do that. How do I go backward, Madison? Back one slide. Thank you. Right, so just quickly, C2ES, we're now in our 24th year. We are an independent, nonpartisan, nonprofit organization focused on strong policy and action to address climate change. Our core mission is to forge practical solutions to reduce greenhouse gas emissions, expand clean energy, and strengthen resilience to climate impacts. And we have a long history of bringing together diverse stakeholders and producing accessible content and publications to help promote climate solutions. So one of the unique features of C2ES is we have a Business Environment Leadership Council, or BELC for short. We like a lot of acronyms. And we also believe that business engagement is critical for developing efficient, effective solutions to address climate change. As you can see on the slide here, it includes top companies in the electric power, manufacturing, high tech, transportation, oil and gas, and finance sectors. It's the largest US-based group of companies devoted solely to addressing climate change. And I should point out that although C2ES is supported by institutional funding from a variety of businesses, foundations, and individual donors, we are solely responsible for our positions, web content, and publications. I did it again, too many clicks. Thank you, Madison. I probably should just let you drive. Okay, so let's take a look at the challenge before us. I'll go into a little more detail. I think that some of this information that I provide will be useful in the upcoming discussion. So we, the United States and the world, we need to decarbonize economy-wide by 2050. Increasing global temperatures, a result of burning fossil fuels at an accelerating rate since the beginning of the Industrial Revolution, are having a profound effect on our climate. So today, the world collectively emits around 50 billion metric tons or gigatons of carbon dioxide equivalent each year. And that's more than 40% higher than emissions were in 1990, when they were around 35 billion gigatons. Once carbon dioxide is in the atmosphere, it takes centuries to break down and dissipate, on the order of 100 to 200 years. We are injecting carbon dioxide and other greenhouse gases into the atmosphere faster than they are breaking down. As a result, atmospheric concentrations of carbon dioxide are now greater than 410 parts per million. They've increased fairly dramatically since the 1960s, when they were only around 300 parts per million. And just for a point of reference, pre-industrial levels were around 270 or so parts per million. As a result of increasing concentrations, we've seen a commensurate rise in global temperatures. Average global temperature in 2021 was about 1.1 degrees C, or 2 degrees Fahrenheit, above the pre-industrial era, making 2021 the 7th hottest year on record. 2020 tied 2016 as the hottest year on record. And basically the last 7 years, I believe, have been the hottest years on record. So with each subsequent decade, we are seeing hotter temperatures or warmer temperatures. And the warmer air and water are causing the sea level to rise. extreme weather events to be more frequent and intense, and rising carbon dioxide concentrations are also making the ocean more acidic. And climate change impacts, as we see on a fairly regular basis, are here and now. In 2021, there were 20 weather climate disaster events with losses exceeding 1 billion each that affected the United States. And the events included 1 drought, 2 flooding events, 11 severe storm events, 4 tropical cyclone events, a wildfire event, and 1 winter storm event. So our time to act and avoid the worst impacts of climate change is limited. Many studies have shown that we need to completely decarbonize the US and global economy and achieve carbon neutrality by mid-century, by 2050. And as you can see in this chart here, we in the United States, we have a lot of work to do. The chart shows US energy-related CO2 emissions since 1990. This is from the Energy Information Administration Annual Energy Outlook. They produce this every year. There should be a new one coming out fairly shortly. It usually comes out in January or early February. It shows the business. It shows the reference case and the colored lines, and the business as usual forecast as dashed lines. So we've seen some declines in emissions since 2005. Economy-wide energy-related CO2 emissions have fallen about 19%, and power sector emissions, which make up around 30% of total energy-related CO2 emissions, they've fallen by around 35%. These are preliminary numbers. We'll have the official numbers around March for 2021. So that's kind of a rough calculation. And a combination of market and policy forces have led to the emissions decline over the past dozen years. We can get into more detail on that. However, the EIA forecast shows that absent new policies, we're not expecting to see further emissions declines. The black dotted lines are indicative of where emissions need to get to by 2050. So you can see the turn that we need to make. And we believe that, and many others believe, that policy is required, that market forces alone are not going to get us there. All right. Now on to this decarbonization challenge. What's the plan? How are we going to decarbonize the economy? So pathways to deep decarbonization generally focus on 3 equally important activities. And the first, I think, is increasing deployment of energy efficiency. So there's a lot we can do in making our buildings, industries, and transportation more efficient than they currently are. And this is driving at, if we need to reduce the total amount of energy that we are consuming. We can be a lot better at that than we currently are. The next sort of pillar is energy supply decarbonization, which involves decarbonizing the electric power sector. And finally, we need to promote end-use fuel switching, primarily to electric sources. So, for example, what we're seeing now is switching from gasoline and diesel-powered to electric vehicles in the transportation sector. And we've seen a lot of movement in this area, with just about every major global car company announcing billions of dollars of investment in new electric models and battery factories as well. In other sectors, we need to use more electrically driven appliances, like in buildings. We need to use more electric water heaters and heat pumps in residential and commercial buildings. But importantly, there are challenging sectors to electrify, like industry and aviation, for example. So these are some end uses that cannot be practically electrified. They can be, but they would come at extreme costs, or there's just significant challenges and hurdles. And in these instances, we are considering paths of less resistance, like using fuels like hydrogen, biofuels, renewable natural gas, and synthetic fuels will be required. So a lot of people out there think and promote the idea that we can electrify everything, but as a practical matter, electrifying heavy-duty trucks, aviation, industrial heat are really, really hard. And so we're going to have to consider, or we are considering using some alternatives to that. So that's a key point that I like to try to get across. So and that developing those fuels in addition to having a non-emitting eventually power sector and a greatly expanded power sector, because it's going to be relied upon for much more than it currently is today. So yeah, I've done it again. One slide back. Apologies. All right, so there are many opportunities to continue to make progress on decarbonization, and I pointed out that we have made decarbonization progress, but we need to really accelerate the progress that we're making, and then this is really going to lead to the discussion that we're having today. So we've made, the power sector is where the most progress has been made, yet we still have quite a ways to go. And some of the contributing factors to the progress that we've made, we've had federal research for decades in development, demonstration, and deployment of a range of technologies, from solar electricity to batteries to things like horizontal drilling and hydraulic fracturing, that have led to significant advances, cost reductions, allowed the commercialization of many technologies, and that those have all resulted in emissions reductions that we're currently seeing today. On top of that, there have been some federal programs, federal tax credits, for example, like the production tax credit and the investment tax credit, that have incentivized and helped to speed the pace of clean technologies. Additionally, state policies have helped to promote clean technologies. Many states in the late 90s and early 2000s came out with renewable portfolio standards, initially requiring that a specific amount of electricity should be generated by renewable sources. And over time, the standards have increased in ambition, and a handful of states now have clean electricity standards, which allow other types of electricity like large hydro and nuclear power to count toward the state's clean energy goals. At the same time, many corporates, many companies have clean energy targets too, and this is helping to drive demand and deployment of clean electricity. So arguably, because of federal research and incentives, as well as those state and corporate policies, solar costs have dropped dramatically, and deployments are accelerating. And every year, basically, we're seeing a new record in solar capacity additions in the US and globally. I should also mention that internationally, targets like those set through the United Nations framework on climate change, they're also helping to keep the focus on decarbonization efforts. So the United States has a new pledge to the Paris Agreement of reducing its net economy-wide emissions 50 to 52% below 2005 levels by 2030. Yet at the same time, there are many challenges here. I've listed a few. We currently lack comprehensive, or I would say strong, federal policy to combat climate change in the U.S. There are some policies and climate-related incentives, as I've mentioned, but nothing like a price on carbon or an economy-wide clean energy standard as well that would really move the needle on removing carbon dioxide from the atmosphere. So we lack solutions in some sectors, or good solutions or practical solutions in some sectors and applications. We need to do more in innovation in helping to build up commercialization of hydrogen and other liquid fuels and gaseous fuels as well that will have important applications. Yeah, there's always in the background too, there's this ongoing challenge in the power sector or a resistance to building new transmission lines, which are critical for decarbonization. And as large-scale projects, renewable projects, any other projects really are moving closer to where people live, there's growing opposition to these new power generation projects. Now, those I would classify as major challenges, but there's another one too, and that's really the crux for today. At this point, I want to characterize inflation or greenflation as more of a speed bump, but it certainly could become a major challenge. I think it's something important to look at. The higher commodity prices, supply chain disruptions, and challenges procuring critical materials. Basically, so for the first time in the solar world, at least, people the price of solar panels are going up rather than down. After years and years of major price declines, they have suddenly become more expensive. We're seeing a price inflation for solar panels. So just a little bit of, so we're all on the same page here, a little bit of background information. What exactly is inflation? It's rising costs of goods and services over time. So, with commodities are interesting. So commodities fluctuate quite a lot. Inflation is maybe a little more sticky in that the prices actually stay high over time or for a longer period of time. And because of that, it's generally perceived as a bad thing, as it can raise the cost of living, particularly if your income doesn't keep pace with inflation. Your buying power declines. So lower income families and people who live on fixed incomes are the most impacted by inflation. So one of the roles of the Federal Reserve Bank is to manage inflation, to try to keep it under 2% on an annualized basis. And they follow not the price of a single item, but they look at a basket of goods. And they're following something called the Personal Consumption Expenditures Index, which covers a wide range of household spending, and that index is produced by the Department of Commerce. So inflation, it's very topical. It's in the news right now. It's at the highest level annualized that we've seen in 30 or 40 years since the early 1980s. Both because of the pandemic and government's reaction to the pandemic. So the Fed is expected to begin raising interest rates in March of this year, and some analysts expect 4 small interest rate hikes spaced out through 2022, and not really sure what happens beyond that. The Fed moves slowly and looks to see what impact that has over time, so that the impact of that will dictate what happens in 2023. So by raising interest rates, why are they doing that? The theory goes that the hot economy that we have right now will cool down a bit, and demand for goods and services should lessen, and prices in some instances will recover, but some prices may stay higher because of things like wages had to increase to retain workers. So that's a little bit more sticky, and that could contribute to more permanent price rises for certain goods and services. So I think we've introduced a definition of greenflation to the audience, as it relates to the energy transition, and as the world accelerates toward the transition to low or net zero carbon emissions, or decarbonization, as I've called it. Demand for those infrastructure investments will lead to price shocks or rises associated with rising commodity prices, metal prices, energy costs, and even things like carbon taxes, if we eventually have them here more broadly in the US. Effectively, everyone's competing for lithium, graphite, copper, silicon, and energy. It's too much money chasing after too few goods, so we're seeing price shocks. So already, interestingly, there was a big report that came out yesterday that we're seeing a huge price tag to pay for all the changes that we need to have a global decarbonized energy system. So McKinsey released a report yesterday where they put a price tag on it. They've looked at how much we would need to spend out to 2050, and they've just the headline number is they've averaged it at about 9.2 trillion in annual spending on physical assets out to 2060. Now we'll spend a lot anyway, so that's important to consider, but it does represent about a 3.5 trillion more price tag than the world currently spends. So that's not insignificant. That's about a 60% increase than we're currently spending on power sector infrastructure and other sector infrastructure. So it's a fairly big price tag, but the signal is out there. So I think we have some policy. We have price signals. We know corporates have signaled what their intentions are. So these are all the factors that are out there and contributing to inflation or greenflation. And I think I've probably gone over my time, and I'll leave it there. And I think I've hopefully set up some good food for thought for our discussion.
Thanks very much, Doug. Without further ado, Sarah, are you ready to take it away? You look you are. Good?
I'm ready. How are your parakeets enjoying this so far?
The parakeets are having a wonderful time. And they'd much rather listen to you than me. So go for it. Thank you.
Well, thank you, everyone. I have learned so much from my two co-panelists. So this is a real pleasure to get to think about the economic impacts of the work that I've been doing full-time as outside counsel to a number of different private equity firms and banks and different corporations. So it's very interesting to think about this as a global big picture. And because I have a very typical lawyer brain and I need a tactile example of how this works, and I love shopping and fashion, I thought I would use the fashion industry and ESG issues in supply chain as a case study of how greenflation might impact certain soft commodities like cotton. Madison, I'm going to ask you to do the slides because I think I was accidentally touching Doug's slides, and I'm sorry, Doug, if I messed up one of yours. Okay, so I always think of greenflation, and I think a lot of the news covers it in the context of hard commodities like minerals and oil and gas and things that have very tangible correlation to climate change and those types of impacts. Soft commodities like cotton are also a natural resource that is impacted by a lot of the same trends and topics that my two co-panelists already mentioned. So just kind of thinking about it and how ESG issues can be baked into regulatory actions that then might impact pricing of commodities and have a larger impact on supply chain issues will be our study here. So we're all wearing clothes right now, presumably. I don't know if the parakeets are dressed, but we all have these different textiles. And so it's a very tangible example of something that requires the growth and production of raw materials. So like cotton, it requires land to grow these raw materials, lots of water. Some folks use different fertilizers and insecticides, and there's a lot of inputs into the production. Once it's made, it of course requires a lot of other natural resources and inputs to process it and manufacture it. So, cotton mills might use a lot of water, a lot of energy. Again, there could be use of chemicals. And then human labor is important for both the production of the raw materials, the processing, and then throughout the supply chain manufacturing. So when I think about ESG and I'm helping clients orient what's important if I'm looking at an investment in a manufacturer of apparel company. So there's so much to think about when it comes to ESG. It's nearly every single issue. It impacts on the environment and humans, and then humans impact on the environment and other humans. just kind of trying to boil it down to what is most important to a particular industry. We typically look at the SASB standards as our go-to place to help orient materiality and look at other initiatives and voluntary frameworks that the fashion industry, for example, might choose to follow. Here we're looking at 4 big issues, but we're going to zoom in now on material sourcing and human labor. Next slide, please. So these are just charts showing that the US produces a lot of cotton. China is the #1 cotton mill user. So in terms of soft commodity sourcing, we're really thinking of China here as one of the primary origins. Next slide, please. And a lot of this comes from Xinjiang. So this is over 85% of China's total cotton production is grown in this area of China. And a lot of companies in the cotton industry and then suppliers downstream in the supply chain might have ties and might source goods and materials, including cotton, from this area. Next slide, please. So this goes back to some of the ESG issues we think of from a materiality standpoint. So I'll just go to the next slide since we're going to just go to that bottom right, forced labor and human rights bullet. One of the major material ESG issues we always think of when we're looking at any sort of commodities, supply chain commodity issue. So for here, hopefully this is not news that we have a geopolitical, a lot of geopolitical press coverage, a lot of news, a lot of focus by this administration and also the prior administration on how best to impact through U.S. commerce different reported human rights violations in Xinjiang. And so there's been a lot of press about forced labor programs and relocation efforts to force assimilation and have some sort of reduction of that specific population. There's also some reports that indicate that certain minority groups were forced to work at sites that include the production of cotton and cotton mills at wages that would be significantly lower than living wages. So this naturally brought a lot of attention to this issue. Next slide, please. And so we now have a law that was just signed by President Biden. I think it was right before Christmas because I remember reading it, lots of press about it on Christmas Day. This is something, the Uyghur Forced Labor Prevention Act. It's one of a number of different federal initiatives that are, again, trying to address this ESG issue of forced labor and human rights. And this brings me back to just kind of putting it in context for those of us who've been doing this for a couple decades now. This is reminding me of the conflict minerals SEC disclosure. It's very similar in the way that the different, Michael, why are you shaking your head?
I just couldn't get over the acronyms here, that's all.
I know you told me no acronyms, but I didn't want to have 100 slides. So just disregard the acronyms and only focus on the fact that this is really going to have a significant impact on any US company that is going to be importing silica-based products. So to Doug's point, anything with the solar industry is going to be reliant, and this will impact the solar industry quite heavily. It also covers cotton. I believe tomatoes are also included. But there are certain goods where the import of them might be prohibited by the, I'm going to need to go back to them as things, I don't have these acronyms memorized. But the Tariff Act is going to be the primary driver. And what this law is going to do, when it becomes effective on June 21st, 2022, unless it's litigated and tied up by a lot of different administrative actions, which is, of course, what is very likely to occur here in the United States, there will be a rebuttable presumption that anyone who's importing goods from this region of China needs to be able to demonstrate with clear and convincing evidence. So what this means is that there's going to be basically a mandatory ESG supply chain due diligence requirement for any company in the US who is going to be importing these specific goods. So next slide, please. And just the reframing of it and thinking of conflict minerals, when the SEC finalized the conflict minerals disclosure regime in 2012, it was I think probably the first example of having public companies or other issuers in the United States having to think about what their supply chain looks like with respect to those identified minerals, and do this type of due diligence process, which is good business first and foremost, but secondly, the requirement then to have disclosure in an SEC filing brought the regulatory scrutiny to those types of issues, very, very heavily. And that's, I think, where we are as well with respect to this weaker law. The other interesting law and bill that was also proposed right around the holidays was the New York State Fashion Sustainability and Social Accountability Act. Now, takeaways from this, and my slides look a little bit messed up, so I'm sorry about that. But the point is that this will, if passed and if implemented in New York State, for fashion retailers doing business in the state with 100 million or more annual worldwide gross receipts, will have to disclose what ESG policies they have, how they do due diligence on ESG issues in their supply chains, how much of their raw materials, including cotton, are sourced and produced in these specific areas of the world where there are known human rights issues. If this were adopted, it would be the first example of comprehensive prescriptive ESG due diligence law in the United States. So I'm excitedly following this. I'm sure there will be a lot of attention on this as it goes through. Next slide, please. So this is my attempt to be an economist when I'm not. I'm clearly just spend my days doing strategic guidance and counseling to clients on how to actually operationalize these ESG issues. But my sense is that these takeaways are correct, and I'll defer to Doug if it matches up with your analysis. And I'm happy to just go to the next slide because this is my so in just thinking of what we attorneys can do to stay abreast of ESG developments and how to actually make it practical, digestible, and actionable by companies. One thing I hear all the time in my practice is size of annoyance, size of overwhelm, and just like a willingness to just give up because there's so many different components of ESG, and it's so top of mind for every single company and investor. And so one way that we lawyers can help folks understand why it's important is to try to stay abreast of the major developments and make sure that we're breaking them down to bite-sized information for clients. So anytime I see anything happen with the New York bill, or if I see additional things happen that might impact supply chain issues and implement some sort of regulatory implementation around human rights due diligence, I'll send my clients a quick email on that and with links to all the background documents. But I think it's like keeping people's attention on why these are important, because they're being baked into hard law finally after years and years and years of voluntary initiatives. I think that's the number one thing that lawyers can help do. The other more common sense thing is that we lawyers will be looking at different legal risks of compliance or failure to comply with these types of legislative and regulatory requirements. Again, so much of this has been voluntary in nature. There have been voluntary ESG disclosure frameworks for years. We expect that SEC will have some sort of proposed rulemaking around ESG frameworks, hopefully later this year, so we can see the proposal. And we know there's a convergence now towards an international ESG disclosure standard. I hope to see that in my lifetime or before I retire. I think it will happen, hopefully, in the next, my guess is 2 to 5 years. But in the meantime, it's helping our clients balance the hard law and the soft law obligations, the different voluntary initiatives, and how they can make their businesses the most attractive from a long-term value creation standpoint to harness the power of ESG. And part of that is a lot of companies have really robust supply chain diligence procedures already because it's good business to do so. And so while I'll set aside the economic impacts of perhaps adding some additional steps around auditing for specific human rights and forced labor issues in the supply chain, my sense is that this won't be a significant cost impact on companies, at least those who have really sophisticated supply chains already. But again, I'm not an expert in that area. But what I am an expert in too is helping develop due diligence procedures for our clients and for companies, banks, anyone who needs to analyze what the potential risks are and the opportunities. So that's something, of course, we corporate lawyers are due diligence pros. And I love working with other consultants in this space. There are, of course, a billion ESG consultants, a lot of technical providers who have great software and great tools that can help companies map their supply chain and identify maybe higher priority areas where they should focus in terms of ESG sensitivities. And so it's a pleasure to get to work with those types of experts too, to bring all the tools to our clients to help them manage and digest all of the potentially material ESG issues. What did your birds think about that? Michael, this is just a picture of me.
I know. I recognize you.
Thank you.
Good. Yeah. Thank you. Sarah, are you all set? Are you finished?
I'm all
with your
set.
presentation? Yeah. Okay. Good. Well, let me begin by thanking all three of you for these terrific presentations and very, very provocative presentations. I don't have. All right. Madison is shooting me a question from the audience, and has there been any instances where the costs have been reduced with the implementation of environmentally friendly practices? Anybody who cares just to speak, just go ahead and talk to us. Sarah?
I mean, anecdotally, if I'm thinking of like different wastewater reduction efforts and different water supply and water sourcing environmental regulations that have evolved over the past 2 decades I've been doing this, I've certainly seen cost savings in oil and gas industry clients where they've had to adapt to those types of regulatory drivers, but they ultimately save money. Same with reuse of methane and different, avoiding flaring for oil and gas operations and being able to sell that gas as a separate work stream. So I think there's a lot of examples, most likely, of there not always being long-term cost increases. I'll defer though to my co-panelists.
Urvashi, Doug, any 2 cents you want to throw in here?
Yeah, I was gonna.
Sorry, go ahead, Doug.
Okay, Sarah kind of alluded to it, but among the larger providers of or marketers of natural gas, some of the initiatives that they've undertaken really on their own. I'm not sure how. I think regulation is coming for methane. It's going to be more widespread, but among the larger producers, the ones that have actually invested in cleaning up their distribution networks, they've realized significant or they've been able to reduce leakage fairly significantly in their distribution system. So that's certainly been a positive, because methane is an extremely potent greenhouse gas when its fugitive emissions leak quite a lot more than carbon dioxide.
Did you have?
Yeah, I mean, Doug and Sarah already gave concrete examples, but overall, I just wanted to add that anytime that, from experience, whether it's in the U.S. markets when we had, U.S. had sulfur dioxide and nitrogen oxide cap and trade or environmental emissions regimes, our experience time and time has been that if there are regulations or imminent regulations, the private sector usually responds in a much more nimble manner than anticipated typically by regulators or other analysts. And so whether it's like a medium term or even sometimes short term, price pressures do settle down. I'm not saying it's true for everything, but a lot of the times when the industry has, when the private sector has been given opportunities to adapt, and especially if they're anticipating a change, they don't start like companies don't start thinking about after the regulation has been in place. They think about it when the buzz starts, like years before. So there's a quick adaptation and nimbleness to the private sector and that leads to price reductions, sometimes drastically. I know Doug talked about solar power generation, and the price of solar cells went down from when Germany was predominant producer to when China became the predominant producer. It went from like a few dollars to a few cents, so which led to the implementation of solar power renewable or adaptation of solar power. It helped it because the prices weren't so low. So yeah, the first time they've gone up now, but they've been down for a long time and cents to $1. So I think inherently the price pressure is a high price. Inflationary pressure may not be long term for again, not for everything, but for at least for in certain cases.
If you don't mind, I'd like to ask the panel a question that's based on the work that I do, and a couple of you touched on this about the cost of energy efficiency moving in different directions. Here's the deal. Using solar panels as an example, there are some programs, not a lot, but some programs where you can get some financial assistance to put solar panels on your home or your property, right? However, solar panels, I understand now, and I haven't done as much research as Doug has, but solar panels that I've seen now can come with 30-year warranties, okay? Now, in project finance, the rule of thumb is that you never finance anything for longer than its service life, and you're dumb if you do it for shorter than its service life, frankly, right? So you got a school bus that'll last 10 years, right? If the school board tries to finance the damn thing for 20 years, they're nuts, and you should replace them. But so should you replace them if they try and finance it for 5, right? So anyway, the idea here is that you finance things over their useful life. Banks don't particularly like this idea, but governments do. And so the idea is that that's number one. The price difference of paying for a solar panel on a 10-year loan versus a 30-year loan is enormous. And if you want, the rule of thumb in environmental finances, if you want to improve environmental quality, do more projects like that, right? And the way you do more projects is by making them less expensive so more people can do them. So anyway, that's the deal. And the other thing is, when if you have a city, and by the way, I'm cribbing from a program that was started in Berkeley a few years ago called the PACE program, which is Property Assisted Clean Energy. That's the acronym of the day, PACE. Yeah, the PACE program. What happens is the city of Berkeley, you want solar panels on your house? You borrow the money from the city, right? And the city issues a bond, and the bond is 30 years, not 10, right? And the bond rates, as you may know, municipal bond rates are lower than any other rates in the marketplace, right? And so you've got the longest term and the lowest rate, and that's the goal, is to get more projects done. Okay, so and here's the kicker. If you buy a solar panel and you get transferred to Seattle the next week, or the next day, or the next month, right? If you've got a bank loan, you got to pay the bank loan off when you sell the house, right? If you do it through a PACE program like I described, the solar panels stay with the house, and so do the payments, because they're collected by the city of Berkeley or whatever city, They're collected with the annual real property tax payments. And that's how the whole system works. Anyway, I gave you a long, I'm not supposed to talk. I'm supposed to sit here and be moderate. But I wanted to give you this example because this is a terrific program that's gone absolutely nowhere. There are 14 states out of 50 who have implemented something like a PACE program, and a handful of cities. And that's it out of the entire country. So to what extent does, we're talking about the environment and money here, I guess this is the basic. Any comments on any of this in terms of, do you guys see this as a major force having long-term, in other words, when we're talking about money, having money on the positive side, having money there when you need it. Any thoughts? I hope somebody.
Yeah, I'll jump in. There's a lot there with a lot of issues with regard to home solar. I might argue, there have been studies about how much of an impact if we used all the roof space, for example, that exists on top of factories, buildings, homes. How much of the solution that can be. You look at costs for a utility scale solar versus residential solar. It's so much more efficient to do utility scale solar. The prices are so much cheaper. I think I understand the desire of individuals to be self-sufficient and self-generate and to contribute to using less. I think PACE would be great for things like getting people to convert from natural gas appliances to and natural gas furnaces to heat pumps and electric hot water heaters, which would be more significant, I think, than putting solar panels on people's roofs. So I think we really have to look. This is a huge challenge. I mean, it cannot be understated how much we need to do. And that some of these sort of pitched battles that we have between and maybe it comes down to utilities. And there's the other concern that's a real concern too is when too many people start putting solar panels on their roofs, then that creates issues in distribution networks for substations and very old equipment that's in a lot of neighborhoods, and who pays for that? So I mean, there's a lot of challenges that get introduced from that particular issue of residential self-generation. So I'll hand it over to Urvashi.
Great. Yeah, it's interesting that you mentioned PACE. I was actually delving into it a couple months ago, just for a couple of projects. So, I mean, you probably know this much better than I do. You specialize in environmental project finance. So PACE has some implementation issues, which has, I think, in my opinion, has impeded the adoption. I think it's in 3 states now, and there's a dependence on private contractors and door-to-door sales by those contractors, and there are some pricing issues, and a lot of consumer advocates have spoken about it, including like the NCLC, or the National Consumer Law Center, which is a consumer advocate. And some of the criticism has been that there are private contractors that solicit and enroll homeowners in these loans without doing like their due diligence about ability to pay, and and of course a lot of these PACE liens may not be covered by Truth in Lending Act, for example, and so there are some implementation issues there. I think that that have resulted in some impediments. Based on how effective or how impactful it is in like lower LMI communities, also like another issue here. So not to delve into much more detail about this, but I think as an idea, PACE works, but in terms of implementation, there have been some impediments there.
Yes, indeed. Sure. There's another impediment is that if you did a PACE loan, it was prior, and you have a mortgage on your house, the PACE loan gets paid off. It's by the city, right? It has a higher priority than the home mortgage does, which means the banks went nuts. And to represent the banks,
Fannie and Freddie also will not touch it.
The godfather of all banks. But no, but I'm Fannie Mae, the godfather of all mortgage banks. Fannie Mae stepped in, and that has caused a bunch of states to have not PACE programs, but they call them C-PACE programs, C-PACE, and that's for commercial. Because they won't do home mortgages because of Fannie Mae. Fannie Mae doesn't want your solar panels in front of their mortgage. But anyway, the C-PACE programs work. So anyway, sorry, go ahead.
No,
Nobody
that's
else? Okay. Let me go back to something that Doug said, and I'm gonna screw this all up, but it was at least I took a very general observation. How important is greenflation, all that we're talking about? How important is this to a family? Is this an academic exercise? Are people, you know, what do you think the impact is in all the different areas to the average family in the country? Just give me your thoughts, whatever. I appreciate it.
Yeah, so I'm not sure how important greenflation is in particular. I would say the bigger piece, and I'm a firm believer in being forthright and honest about, you know, renewable electricity is quite cheap relative to the alternative, but still a lot needs to be built, and that will need to be paid for and amortized, you know, and absorbed by ratepayers. So just the sheer act of an energy transformation will lead in the short, medium term over some period to higher electricity bills. And in the fact that there are also fossil power plants that are not fully paid off for as well. So that has to be paid for. And the fact that we need to pay for a just transition to account for a workforce that needs to shift into other industries or other aspects of the clean energy transition. So those are all going to be felt by consumers. When you do policy like a carbon price and you actually get revenue, you can help to offset some of those price rises. And I think that's quite a fair and important thing to do, especially for the lower decile households. But yeah, everybody could conceivably get some kind of dividend check in a carbon under a carbon pricing scheme. So the greenflation aspect itself is there in that if there are these periods where there are supply shortages and or factory rates or wages have to increase, and then it actually winds up becoming a bit more expensive than the models forecast it is because of these price shocks that get introduced, and that only adds to the price tag as well. I would say that is probably a lot less significant than the price tag of just building all the new infrastructure that we need, period. And that includes transmission and new generation, swapping out appliances that are no longer, you know, green compliant anymore.
Okay. Sarah, Urvashi, anything to add here?
Sure, happy to add a couple things. I think I think ESG trends overall, whether it's for energy transition or they're more focused on more scrutiny on supply chain issues. Sarah mentioned, like in cotton growing, when it's human rights issues in supply chain of cotton growth or tomato picking, for example, or So they have, I mean, they're bound to be cost increases for companies, which, you know, could ultimately be those price increases could be transferred to end consumers in terms of higher priced items. Supply chain issues for oil and gas, for example, or other like other hard commodities could result in some price increases for households, especially households of like in LMI households, or I mean in general all households, but LMI households might just face the pinch a little bit more, like Doug said. So I mean, there's an indirect. I mean, directly I may not see it, but indirect impacts on all these developments. Definitely, if to the extent that there is, at least in the short run, there is an inflationary pressure, we will see it in consumer items too. But how much of it is because of overall ESG trends and greenflation, or how much it is just like our current challenges with aging infrastructure and supply chain and global trade flow issues, which are beyond greenflation, that's not clear. It may be like, truth is always somewhere in the middle. It may be a bit of both. And as we know that the world is becoming smaller and smaller, these issues get complicated and kind of impact globally. So, and pandemic is not doing us any favors here either.
Good. Now, a question from the audience here. Urvashi mentioned briefly, but how is the pandemic affecting commodity prices in the environmental sector and greenflation? What's the pandemic doing to us?
So for the pandemic immediately has stalled a lot of global trade flow just because of transportation issues. It was huge last year, especially when the pandemic began. Second, it has just highlighted and put in our face the socioeconomic inequities and complications dealing with like global crises, right? So not only in terms of price pressures because of transportation limitations and global supply chain issues, but also in terms of how people view what people focus on. So like I said, I think I mentioned when I was in my presentation that the pandemic has just brought to forefront some of the socioeconomic issues, which has then led people to even more pay attention even more to the S in the ESG, for example, healthcare and having lower income people with lower income were I don't want to be crude about it, but had higher death rates and had higher hospitalization rates. Like facts like that, they do impact how people react to some of the issues that are impacting us, right? So I think more focus on the S and the ESG as a result of COVID, and also the focus on the fact that there is a government spending, like not for COVID only, but the government did respond in spending on infrastructure, or climate and social economic mobility is an integral part of whether it's the infrastructure bill to a certain extent, or also Build Back Better if whatever happens to it. But I mean, whether it passes or not, it is in the political conversation, and it's top of mind for a lot of people. And that has an impact on people's lives, and presume and in terms of direct link of COVID to price inflation, I feel that they're competing or disparate trends that have come to play here. I don't know. Did I answer?
Yes,
I thought I was rambling for a bit, but.
Doug, Sarah, anything you want to add?
If I could just echoing, the focus on S has just been exponential because of the pandemic, because of the social justice movements around the world last summer. And one thing that I'm finding, just the impact of mental health and well-being and employee engagement programs, and looking at that from a real materiality standpoint when looking at different companies and mergers and acquisition diligence, or helping advise on ESG programs. Mental health and impacts from the pandemic are something that each one of us can really relate to. But when it's tied up into the serious impacts on earnings of major Wall Street banks or other employers who are experiencing significant impacts from the Great Resignation, that I think this is way off topic and not related to greenflation at all. So if you ever want to do one of these about mental health and ESG, let me know. But presumably things will cost a bit more when companies have to certainly pay more for employees now.
Not to tie directly to greenflation, but one of the other impacts of which has been brought to light as a fallout of COVID-19 and what has passed since is a pressure on compensation, employee compensation, especially in the US, like where people are demanding more compensation for the same or higher salaries or more compensation for the same work. So that also has a price or a cost pressure on companies. Also, by the same time, means that higher income, if unemployment rate is as low as, if I believe the numbers, is as low as reported, then it also has means that people have more options and they can earn more for the same amount of work. So both they may be compensated more, and then also at the same time has some inflationary, indirect inflationary aspects as well. So I forgot to mention that earlier, but that seems to be an important aspect as well.
Good.
So I could just add to all that, a delay in project completion is a cost as well. So the fact that supplies are, everyone watched, and they're still backed up at the port of Long Beach in California, but it's not quite as bad as it was. But if you delay deliveries from Asia into U.S. markets, then that's longer till projects get completed, and then they wind up costing more as a result. I mean, some of the direct pandemic effects are, you had factory closures, so you had lower production during a period. China had a zero tolerance policy for COVID infections, so they'll shut down a city, and if there's solar manufacturing in that area, then that's going to be impacted, or other green projects.
Okay. We've only got couple minutes, but let me just ask you quickly, where do we go from here? What are the next steps that can be taken to avoid or mitigate cost increases? Anybody? 2 cents?
Sure. I think, just quickly, and this is one of the points I wanted to get across, like a lot of that modeling that McKinsey did, and others about how much it's going to cost. It's very hard to anticipate what impact greenflation is going to have. So when you see what number that they've come out with, you can assume that it's going to cost more, because there's going to be periods of constraints and where there are going to be price rises. You have every major auto manufacturer in the world wants to open up a gigafactory and produce batteries. There are elements or minerals or materials that they're all racing. It's not just semiconductor chips, it's basic materials like lithium and graphite. There is serious competition for these minerals. The market signals are all there. Developing mines, new sources of production are not easy to achieve. I think that there will be a crunch, for certain materials, and it's hard to predict, because right now the technology du jour is lithium-ion batteries, but there could be a huge advance between now and 2030 in a better battery chemistry, which might point to another material that has not been as developed as some of those materials are becoming today. So there are so many unknowns in the path to decarbonization.
Good. Anybody else? We've got a couple minutes. No? Okay. I just first of all, thank you all very much for your great presentations and for your questions, the questions and answers and stuff like that. I appreciate it, and on behalf of ELI, I wish you all the best, and you all are doing terrific work. Please keep it up. We obviously need it. So, Doug, Sarah, Urvashi, thank you once again on behalf of all of us folks here at the Environmental Law Institute. And thank you. And
thank you to all the attendees. Thank you, Madison. A shout out to you. Thank you for putting this together.
Yes, thank you, Madison is right. Can we go home now, Madison?
Yep, I think we are all good. Thank you once again. Thank you, Arbashi, Michael, Sarah, Doug. Thank you so much. We really appreciate it. And have a great afternoon.
Great. Okay, thank you all. Nice to meet you. Take care.
Bye-bye.
Bye.